out of some of the safety things and going into some stocks down almost 1%. Joining us for the hour, we've got Jeff Sica and Liz McDonald. Jeff, to you first. This rebound here, do you think maybe this could be real, or is it too early to tell?
No, it's way too early to tell. First of all, we were bound to get the central bankers coming out and making certain promises that they could come in and rescue this global decline. So that's what we have. And second is that the market, if you look at the sell-off has been severe, but it hasn't been as severe as a lot of people predicted. So I think it's way too soon to start to think that this is over.
So you're saying that the worst case scenario has got to come true then?
Yeah, because here's what we have to look at. There are a lot of intricate factors involved in the exit.
Yeah. Yeah, but sorry, go ahead, Jeff.
And also, you know, the whole idea of what's happening in the Italian banks and European banks in general with the onerous debt time bomb that's embedded in Europe right now, that's got to come to the surface. And as more referendums become more likely, we're going to see more sell-offs. Don't take the bait. Right. This is a temporary thing.
Well, here's the thing, too. S&P, Capital IQ, I think, did this research saying, hey, what happened when shocks like this occurred since World War II? They're saying it ranks 7th. You know, in other words, they looked at Greece, a taper tantrum, the Boston Marathon bombing, other terrorist attacks. They looked at Nixon's resignation, the shooting of the President Ronald Reagan. They said it's right in there, about average, with about 3.6% downturn, 3 to 5% downturn. They're saying, watch this. Usually when things like this happen, you'll see the markets go down overall about 11% and then start to rebound about 3 months later. So you could see a fall rally, September rally.
Or we could see wild gyrations for some time.
Yeah, that's right. That's the point.
Well, also you have to look at the fact that it's not only Europe. We are still in an anemic economy. We still have an earnings recession. We're in the midst of an earnings recession. We still have a lot to be concerned about right now. So any temporary quick fix solution is not enough to correct all these underlying issues.
I don't think anyone thinks there's a real quick fix, at least to the economic woes of the world. In the meantime, these banks